Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss year-end tax planning for retirees. Specifically, I'm going to chat about the most important time of year for a financial planner versus an accountant, the tax valley retirees must plan for, 5 strategies we consider during our year-end tax planning, a conflict of interest that can hinder good tax planning, ways to make a coherent tax plan that considers investment and retirement income planning, and lastly, as always, a few action items for you to consider. Well, it's that time of the year again, year-end tax planning for those of you who are within 5 years of retirement or recently retired. Now, most of you out there relate tax time to April, when you file your taxes and wait to see what the damage is. But for us financial planners, the last few months of the year are a time to make a plan for how to minimize that tax bill when you end up filing next year. That's because, all of the decisions you make with your personal finance in the calendar year will impact what that tax return looks like next year. Now, sure, if you find yourself in the late stages of, your working years and you're still contributing to RSPs, yes, you do have the first 60 days of the new year to make the decision to make contributions to offset tax. Or if you're operating a business with an operating company and holding company with a separate year end, you may have a few other dates where taxes are top of mind. But for most pre-retirees and recently retired, the year end is when everything should be reviewed and a tax plan set in motion. See, unlike most accountants, certified financial planners are thinking about ways to minimize tax today, over the next 30 plus years of your retirement, and to your final estate. Simply put, we don't just look in the rearview mirror to see what has already happened. We're looking well into the future, helping you make tweaks today, here and there, that could save you thousands, if not hundreds of thousands of dollars in tax over the course of your retirement and to your final estate. And in my opinion, tax planning is where an advisor really earns his or her salt and can justify the advisory fees being paid. It's really all about providing value that outweighs the fees you pay. And you know what? We believe strongly that it should be illustrated to clients and to prospective clients. If you are a year or so from retirement, planning your next 5 years from an income and tax perspective is incredibly important. See, for most, when the income stops from work, there is a brief window of time where tax planning strategies must take place. And I call this the tax valley. The tax valley is that time when, again, your income stops and you haven't decided on whether or not to take CPP, old age security, or other pensions. It also may be a time where other taxable events like a land sale or property sale may come into play. Now, it is over this very brief window of time where there is an opportunity for tax planning that can really reverberate throughout the next 30 plus years of your retirement. And I really cannot stress how important proper tax planning is during this tax valley. That is, again, the year or two leading up to retirement and the first 5 or so years after you retire. So with that, here are some things we generally look for to help mitigate tax today, optimize our planning, during that tax valley, and help to create a sustainable retirement income for a 30 plus year retirement. So first off, we want to make sure that the TFSAs are being topped up and invested properly. The tax-free savings account, as the name suggests, is a savings account, but the reality is that nearly any investment can be held in the account. I do continue to come across individuals and families with a sizable retirement nest egg that either A, they're just not using the TFSA at all, or B, they have it invested in a way that does not align with proper asset location and long-term retirement planning. The second strategy at year end that we'd like to look at during this, and also during this tax valley time, is considering the impact of delaying government benefits like CPP and OAS versus drawing funds from tax inefficient accounts. For example, if through the course of proper tax planning, you opted to delay CPP, and in the future, you find yourself now with a higher fixed pension amount that is also increased with inflation. And, at that point in time, you even keep more in your pocket on a monthly basis because you're in a lower tax bracket. So let me go through, let me deconstruct that a little bit with an example, just using some simple numbers. So let's assume that at age 65, you're entitled to $1,500 a month or $18,000 annually from CPP. Now, if you wait to age 70, this number increases by 36% to $24,480 annually, or a little over $2,000 a month. So let's say you take CPP at 65 and you're still working. At this point, you find yourself in the 30% average tax bracket. What this means is that of the $1,500 a month you receive as a CPP payment, you only get to keep a little over $1,000 in your jeans each month. Now, through proper planning, we devise a strategy for you to maintain your standard of living, draw down from your highly taxable accounts once you stop working, and delay your CPP to age 70. And at this point, as a retiree, you now find yourself in a lower average tax bracket of, say, 20%. Now, when you start your CPP pension, which is now, as I remind you, a larger guaranteed higher amount indexed to inflation, you are also in a lower tax bracket. So the amount you keep in your pocket also increases. So in this example of the approximate $2,000 in monthly pension that you would receive had you delayed till age 70, now having that taxed at an average tax rate of only 20%, that means you're now keeping $1,600 a month in your jeans, again, after tax. So not only is your fixed CPP pension higher, you're also keeping a larger percentage of the pension after tax. Now, when people ask me this question, they often, when should I take CPP? They often, get fixated on the top line amount of CPP they could receive without considering the true after-tax value of timing your CPP pension. Now, one other quick comment here, and I only bring it up because it really does bother me. I've come across many scenarios of prospective clients where it is just so blatantly obvious that they should be delaying CPP and drawing from their highly taxable accounts first. Now, the innocent excuse I want to say for these advisors is that, maybe they're focused on just investments. So maybe they just don't have the knowledge of holistic financial planning. Or perhaps worse, maybe they do know that you should be delaying your CPP or OAS, but realize it will decrease the assets that you have with them, and with that, their compensation. I digress. Okay, so the third year-end tax valley strategy that we look at is reviewing your household income and looking for opportunities to shift, a current or future tax bill to the lower income earning spouse, which in the process will, end up decreasing the amounts that you have to withdraw from your investments, lower your household tax bill, all while maintaining a sustainable withdrawal rate. Here we look at things like spousal RRSPs, pension splitting, CPP sharing, and more. A fourth strategy we look at is a full, review of your net worth statement. Now, there may be tangible properties like land, equipment, or rental properties that we don't necessarily manage as your advisors, but the decisions you make with these assets directly impacts our ability to create an efficient tax plan. So here, once we start to get into a little bit more of this detail, we do like to work with, your accountants when possible to help develop a coherent strategy that not only considers taxation today, but what it's going to look like in the future. And this is especially important for those of you who, run an incorporated business and utilize a holding company. Now, the fifth strategy we tend to consider is drawing funds from the RIF account before age 71, even if the funds aren't directly needed for lifestyle expenses. Now, this is a very nuanced strategy as it really interrelates with your investment plan and retirement income plan and CPP timing. But, if done correctly, this strategy has the ability to free up tax-paid dollars at a lower rate for future income needs and really mitigate your final estate tax bill. All these decisions cascade into other areas of your finances that can have a material long-term impact on your ability to retire and stay retired. Proper retirement planning is interconnected throughout investment planning, income planning, tax planning, healthcare planning, and estate planning. It is this convergence of these planning focuses that led us to create the Fundamental Retirement Plan, which you can check out on our website. Further to that, this will be our second year of integrating our year-end tax planning value add that we mail to clients with over $500,000 invested with us. This document is tailored for each household by our group of professionals and provides specific feedback on ways to mitigate tax today, during that tax valley, and over the next 30 plus years of your retirement. This year-end tax planning value add we send to clients has over 20 plus strategies that we may utilize, 5 of them which I've discussed here today. Okay, so that will do it for today. Here are your action items. If you are nearly retired or recently retired, I urge you to have a look at your tax valley and take advantage of this very narrow window of time. The decisions you make during this time will have a lasting impact on the tax you pay, the benefits you receive, and your ability to stay retired. Second action item, as a first step to making a plan, take note of the 5 planning topics I've discussed today and consider how they may impact your retirement plan. I'll repeat them here again. Number 1, is your TFSA topped up and invested properly? Number 2, are you considering starting your CPP? And do you have a large sum of taxable accounts like RRSPs and RIFs? How will these decisions you make with these impact your after-tax pensions? Have you looked at ways to minimize household tax, lower investment withdrawals, and maintain your same standard of living? Number 4, have you factored in the sale of capital property or winding down corporations as you enter retirement? And number 5, have you looked at the impact of optimizing your tax brackets before age 71 when RIF withdrawals become mandatory? Okay, so that'll do it for today's episode. For all the links and resources discussed, please check out the show notes. Please be sure to check us out on our socials, on our LinkedIn and our Facebook. If you're enjoying the show, please subscribe and leave us a 5-star review. Be sure to sign up for the weekly Retiring Canada newsletter. And hey, when it comes to retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.